And we are live. Welcome to Financial Literacy Friday. How are you doing, champions? Wherever you are in your neck of the woods, we are excited. We are fired up. And I know today is going to be incredible. It's going to be fire. So if you are an entrepreneur, a business owner, or you're just somebody who wants to know how this big, beautiful bill is going to impact your taxes, you want to come in here, you want to tag somebody, bring somebody else in who wants to know about this, because today's topic is incredible. We're going to be talking about the hidden tax law that lets you eliminate seven-figure tax bills legally. That you heard that right, legally. How can we eliminate and mitigate taxes? Because it's not about how much money we make. It's about how much money we keep that matters most. And today, Chris, this incredible guest speaker, is going to knock it out of the park. She has an incredible message. And first of all, we want to start off with Miss Chris. I want you to share a little bit about your background and how you came into the tax industry.
Okay, so I'm what you call a transformative tax advisor. I am the person who helps you save on taxes, but my focus is not just helping you save on taxes. It is always how do we turn those savings into lasting wealth. So that's what I help people do. And I've been in this space for more than 20 years. I've worked in accounting and tax for more than 20 years, but I came to be a tax advisor because the IRS came for my daughter. So my daughter had just graduated from high school, barely making any money, and she got audited. And you can imagine what she felt. Young adult, no idea how to deal with it, and expecting her mom. She's like, "Well, you're an accountant, you should know how to deal with it," but it's two different things, right? And so I was forced to start investigating the tax code. So I started researching. And the more I researched, is the more that I saw that we think that the tax code is this major punishment, but it's not. It is literally a blueprint for creating wealth. And so the more I dug, is I just got hooked. I found my calling. So it's a really funny thing that something that was supposed to be like a really stressful experience is the thing that brought me to helping other people.
Yeah, that is so incredible. I love how you talk about the tax code is really just like a treasure map, right? It's leading us to all of our treasures, but most of us don't know the rules of the game. I call it, most people are playing money checkers. They make some money to pay some money. They make some money to pay some money. We're teaching people how to play money chess. We got to be 5 steps ahead. We got to understand the rules of the game. And this big, beautiful bill, however you feel about it, there are some rules there and some things that we need to understand. So, Chris, you've been analyzing this new tax bill, and it's been called like the biggest tax opportunity of the decade. So, what makes this so significant, in your opinion?
Well, there's several significant changes, and most of them are life-changing opportunities if you know how to take advantage of them strategically, right? So the first one that I think most people are excited about is bonus depreciation. So bonus depreciation would have been 40% in 2024, then in 2025, then 20% 2026, and phased out completely in 2027. But it went back to 100% for 2025, retroactive to January 20th. And then it doesn't have a sunset date, which means that until that there is another major tax reform, bonus depreciation is 100% every year. So the thing about bonus depreciation is most people are like, well, why is that a big deal? Well, think about this. Depreciation is paper loss, right? So it means that the IRS is literally giving you a break on paper for money that you made. So I'm getting a break to not pay taxes on money that I made, but I didn't have a loss. It gave me a paper loss that creates actual losses for me. So usually, the depreciable property has a set way in which it can be depreciated. It used the maker's system, modified accelerated depreciation system. Now, when you use makers, each property has a time span, and you depreciate it over that time span. Now, What bonus depreciation does is allow you to take the value of that property, whatever you paid for that property in year one, you can deduct that 100% if it meets the qualifying criteria.
100%, folks. Think about this, and it's retroactive. Oh my goodness. So the first thing that comes to mind, Chris, well, a couple of questions, but one is this just for the ultra wealthy? In other words, for somebody that has a huge portfolio of real estate, or could the average person use this?
Well, no, it's not. It's for everyone who has qualifying property. And remember, bonus depreciation is not only for real estate, right? In real estate, you can use bonus depreciation, but mostly it has to be tied with the cost segregation strategy. That's how you open bonus depreciation for real estate. But other property qualify for real estate and for bonus depreciation as well. So say, for example, the purchase of heavy equipment, you could use bonus depreciation for that. You hear people talk about bonus depreciation every year when they're talking about buying a vehicle at the end of the year as a tax strategy, because you get to deduct that 100% if bonus is at 100%, or 80% if bonus is at 80%. The one thing that I would like to say here is, although the opportunity is available for everyone, but because it doesn't mean that because something is available to you that you have to do that something, right? Because so many people are like, I'm going to go buy me an expensive vehicle. I'm going to buy me a Tesla this because I'm using it for my business, and it costs $120,000. And I'm going to depreciate $120,000. Yes, you are. But there's still the note for the car. So before you go out and make that purchase, you have to weigh the financial cost against the tax benefit, right? Are you really able to afford the payment for that asset that you're going to purchase? Or are you just going to purchase it because someone told you that you can get a tax benefit for it? And what most people don't understand as well, because the cost of the vehicle is $120, the $120,000 doesn't mean that $120,000 is the tax benefit that you get. It's $120,000 deducted from your taxable income, but the tax benefit is that $120,000 times the percentage of your tax bracket. So if the car costs $100,000, let's make it simple, and you're in the 37% tax bracket, that's a $37,000 deduction on your tax bill, not on your income, on your tax bill. So if your tax bill is $200,000 and you think buying $100,000 vehicle for bonus depreciation is going to help you, it's not going to wipe out your tax bill. It's the percentage of your tax bracket percentage times the cost of the vehicle.
Right. That is so huge. If you guys didn't catch that, really what she's saying is it's not dollar for dollar. You're using this, buying this big vehicle, or this big tractor and such, but it's not gonna come directly dollar for dollar off of your tax liability. So when we think about this new law that's been upgraded, it's really a law that was existing and now it's giving us an upgrade to it. I'm feeling like there's a sense of urgency then for somebody who's watching this, because you said it would be retroactive to January 20th, right?
Mhm.
So
Yes.
it sounds like there would be a sense of urgency for anyone who's watching this now or on the replay.
So for bonus depreciation or any type of depreciation, one of the things that must happen is that property has to be placed in service before the end of the year. So December 31st, it has to be placed in service. If it's not in service, you can benefit from it. Retroactive applies to any property that was placed in service to the date it is retroactive to. So if you purchased a property in 2024, but the 100% bonus depreciation doesn't apply to that property. It applies to the property that was purchased in January, from January 20th of 2025, because that's where it's retroactive to.
Okay. Yeah, that's really, really good. So basically, we're talking about something that's already been in existence, but now they can use it instead of getting a 40% a depreciation, they get 100% bonus depreciation. I don't know about you, but I love things that are bonus, right? When we go to the store and they give us 2 for 1, I call that a bonus. Anytime I can get an extra bonus on something, I'm going to take that all day long and twice on Sunday. But now, how many times do we get a bonus on the tax bill? How many times does Uncle Sam say, you know what? We let you have this much, but we're going to let you take a higher depreciation. I don't ever know when this has ever happened.
I think the mind-blowing thing about it is, like, if you think about it, a property that would have been, say, if the property is being used for commercial use, would have been depreciated over 39 years, 39 years. And I'm in real estate. I qualify for rep status. I can cost segregate. Now I can take 100% of the value of the cost on the cost segregation study in this year, in this current year, right? And it's the same thing for if it's equipment that you purchase, like, say, let's say I purchased like 10, I'm in manufacturing, right? I purchased $10 million worth of equipment. I can take the $10 million deduction this year, right? I don't have to spread it over 5 to 7 years. I can take that right now. So it is a huge boon for anyone who is really in business right now, who needs equipment or was planning on buying equipment next year or in 2027, and are thinking, well, I have a high revenue year this year, so let me go ahead and move these purchases into 2025 so that I can take advantage of that right now. And then I'll find someone who can come up with some more strategies for me to handle 2026 revenue. But for 2025, the government just gave me a free pass.
So I know you talked about $10 million. Let's kind of break it down for like the average person. Let's say they buy something that's $1 million, right? In California, it could be a property that's easy, or it could be some type of big asset like a tractor or something. So if they
Mhm.
bought something that was worth, say, $1 million, it went from 40% deduction now to 100%.
100%. Yes. So when
100%.
they would have been able to take $400,000 deduction in year one, they can now take the entire $1 million.
Wow. You know, I've
Mhm.
heard I've really heard a few tax professionals saying, you know what, this big, beautiful bill isn't impacting real estate at all. There's no changes in real estate. So I'm going to ask you, to the average eye of someone just looking at the bill, would they see this, or is it something that you really have to be high level like yourself in order to see that this is here built into the bill?
You need to know the rules. Well, when someone says, when the tax code says bonus depreciation is at 100%, and someone who's in real estate, well, how does that apply to me? And the thing is, most people in real estate, it takes them years before they know anything about cost segregation and how cost segregation pairs with bonus depreciation. So unless you have someone who understands it, explain it to you, to the naked eye, to the layman, it doesn't directly connect to me because I can't see the connection. You need someone who understands it to explain it to you.
Yeah, that is such a great point because I know a lot of professional realtors. When I talk to them about cost segregation, they've never heard of it. So I that's a great, great point. So now let's talk about that section 173. That also got upgraded.
Okay, so
Yeah,
section 179 again, right? So this
179.
bill this bill is so chock full with depreciation benefits. So section 179 is another type of depreciation. So it's depreciation for business assets of a certain class, right? So say, for example, you're using an asset for 50% or more business use. It could be your equipment in your business. It's 50% or more business use. You can use section 179 depreciation again to depreciate it and to get that deduction, reduce your tax liability. So section 179, how that worked before, the maximum section 179 was 1.2 million. You couldn't depreciate any purchase above 1.2 million. You started losing the benefit, right? But now that went from 1.2 billion to 2.5 million, 105% increase. And then the phase out went from 3 million, I think it was 3,050,000 to 4 million. So what that means is if I purchase equipment, and I'm going to use a farm example because I have a client who just purchased a farm, and it's a great example to actually walk through Section 179 and then the next depreciation, which is the qualified production property. So I'm going to use that example. So let's say my client just purchased a farm, and the farm is cost 2.5 million, and he's going to buy heavy equipment to work the farm. He's a hemp farmer. So he's gonna buy tractors and the tillers, whatever, all heavy equipment used on a farm, and it's gonna cost them upwards of $3 million, right? So all this equipment is gonna cost them about $3 million. So Section 179 says if I use Section 179 depreciation, I can depreciate up to $2.5 million.
Wow.
The phase out is 4 million. So anything you purchase under that 4 million, you can still get that 2.5 million dollar benefit. So you pass 2.5 million, it reduces, but you don't lose it. Anything above 4 million, you start losing it. When you get to 6.5 million, you can't use Section 179 depreciation anymore. However, there's still bonus depreciation. And if you phase out of Section 179, you can use bonus depreciation. So either way, you're going to be able to depreciate that asset in the year that you purchased it. So
Wow.
again, the question always is, I know I am able to, but should I? Because you have to think about what your revenue is like in 2025. And based on the revenue in 2025, do I need to use Section 179? Do I need to take depreciation on all of the equipment, or do I need to take depreciation on some of it and save some of it for to use in future years? Because there's no point in taking all the depreciation now and your income can't withstand it. You're going to be carrying that forward. So it is, again, on the scale, pros and cons, a choice to make, right? You have to be strategic about this. So there are times when it is, I'm going to use Section 179. There are times when I will use bonus depreciation, and there are times when you will use both. But another consideration is what most people don't talk about when they talk about depreciation. Everyone think, okay, I can get all this reduction on my revenue, my tax bill, and so I'm gonna go crazy about depreciation. But here's the thing: some people are like, I'm gonna buy a vehicle every year, so I'm gonna buy a vehicle this year. I'm gonna sell it before the year ends so I can get another one. But no one tells them that there is depreciation recapture. The depreciation recapture means that if I purchase a vehicle and I use depreciation. So say, for example, I use bonus depreciation. Bonus depreciation says that when you sell that asset, you will the depreciation recaptures. What that means is IRS says that I gave you a break on an asset that you were supposed to use for 5 to 7 years. You used it for 1 year and you sold it in year 2. In year 2, all the tax benefits that you got, now we need to calculate what the actual benefit was for the time that you kept that asset, and now you need to pay that back, and you get taxed on that at your taxable rate. And it's the same thing for Section 179. And Section 179, you have to be even more careful, because Section 179 there's a 50% business use requirement. So for the 50% business use requirement, it means that if I have this asset for 5 to 7 years, and for all these years, I have to maintain a 50% business use. If it dips below 50%, there is going to be a recapture. If you sell that asset, there's going to be a recapture. If you gift that asset, there's going to be a recapture. So it's not just, I'm going to purchase a vehicle this year, use it for 1 year, so I get the depreciation benefit, and then sell it and buy another one, so I get another depreciation benefit. It doesn't work that way.
That is so huge, because I do hear that quite often. And so what comes to my mind is we're talking about Section 179 and the bonus depreciation, two separate entities, but can you use them both together?
Yes, you can. You can.
Oh,
So, okay. So let's take an example for the client, my client who's buying equipment. So let's just say as an example, he buys equipment that is 10 for 5 million. He buys equipment for 5 million. He still gets to take a percentage of section 179 because he doesn't phase out of the section 179 limit. The complete phase out would be 6.5 million, and then no section 179 is available to you. But at 5 million, there's still some section 179 that he can use. So he can use that. And then for the rest of it that's left over that he can't use for section 179, then he can use bonus depreciation for that. So you can combine the two.
yeah. See, this is so good. This is why it takes a strategist. I'm a financial strategist. I partner with experts, and Chris is definitely one of those experts because it's not a matter of just putting in the box, right? You have to strategize. You have to have somebody look holistically and proactively at your own personal financial situation. So
Mhm.
let's talk about like a small business owner, um, buying equipment. What's the practical benefit here for them?
So let's say let's use a physician, a doctor's office. And so doctor's office, the equipment is pretty expensive, right? So they're buying imaging equipment. So let's say a doctor spends $1 million buying equipment in 2025. So he would have to depreciate that asset over time, right? A period of 7 years. And so he's limited to 101 million divided by 7. That's the total that he can take. But with the section 179, he can expense the whole million in that year. So if he is an S corporation, like most doctors usually are, it means that the business itself doesn't pay taxes. He's paying taxes at the personal level. It's a pass through, right? So his income gets reduced by that $1 million. The tax benefit of that is most times, most doctors are usually up in the 37% tax bracket, right? So it's $1 million times 37%. He just saved $370,000 on taxes. So that's $370,000 that he can choose to reinvest in his business. Maybe he needs more equipment. Maybe he needs to expand his team. Maybe he wants to start a new location. He can do that. Or he can be strategic about it and say, okay, I saved $370,000 this year on taxes. How can I leverage that to create wealth for me? And now start looking at tax advantage assets. Now start looking at different types of real estate deals that he can get into. Now start looking at oil and gas for intangible drilling costs that he can get into, to have that same money that he saved create lasting wealth for him and continue to give him tax benefits. You see the difference? The thing that most people don't think about is, my mom used to say this thing, stupid is as stupid does, right? You hear something, you do something, you stop right there. That's it. There's nothing beyond that. You don't think beyond that one thing. It's as if there's only one answer, there's only one path. But when it comes to taxes and wealth creation, the tax code is the blueprint. It's just, what are you thinking and how are you thinking and who is helping you to decipher the code? Because I'll tell my client, you were supposed to pay $370,000 more in taxes this year. So let's do this. Let's look at real estate. Let's look at oil and gas. Because what happens then is those two investments will continue to give you tax benefits that you can use to reduce your taxes in future years while they're giving you growth, most of the time, growth that you can't get in the stock market. So, what are you? It's not just about how much money am I going to save. It is what happens to that money after I save it. How does it get invested? Does it get to create lasting wealth? Does it get to create legacy? What impact does it create? Because if you're just getting a tax break because you're getting a tax break, what's the point? If it's not doing anything else, no impact, no growth, no anything, what is the point?
Absolutely. And I call that playing money chess, right? We have to understand the rules of the game. They're there, but most of us don't have a strategist. They don't have somebody who really is looking holistically at their financial situation. And I would also add that it takes time. So if your person just gives you numbers in, numbers out, and now you have this huge, significant tax liability, and they tell you just write the check. I've had clients tell me my tax person just tells me to write the check. It's worth a second set of eyes on that situation because this is strategic. So let's talk about for our viewers that are in those high tax states, that SALT deduction. It went from like what 10,000 to 40,000. What
Yes.
what does that mean in actual tax savings?
Okay, so state and local SALT is state and local taxes. Oh, and by the way, the QR code on the screen, that's a calculator. It's a calculator that I created based on the One Big Beautiful Bill that you can use to calculate what your savings would be. It is tailored to you, your situation. You put in your numbers based on which one applies to you, and you will get your exact savings. So just scan the QR code, and it's an asset for you to use.
Gotcha.
So the salt and the state and local taxes, right? So say for example, high tax states like California, like New York, usually for your state taxes, your property tax, right, your sales tax, you will even when you itemize, you will limit it to $10,000. You can't go beyond $10,000. So even in a state like Florida, where for me my property tax is more than $10,000. I'm stuck at if I'm going to itemize, I can't deduct more than the $10,000. So if you're in a state like California and you find that your property tax is 20,000, you can now deduct the full 20,000. You can itemize and deduct the full 20,000. If you're paying state taxes, you're paying $50,000 in state taxes rather than being capped at 10,000. You can now deduct 40,000 on your
Wow.
taxes. So this is huge for people in states like California and New York.
That is beautiful. I don't know if you
Mhm.
guys are capturing this, but this is really, really beautiful. So let's talk. I know you and I were kind of talking offline about that some income now is going to be completely tax free, like tips, overtime, Social Security. So who is this going to affect? Who is this going to impact?
Okay, so before we even address that, right? This bill is really geared more towards business owners and investors, and it is because the tax code itself is biased towards entrepreneurship and towards investing. Because if you're an entrepreneur, you're hiring people, you stimulating the economy, you providing social services that the government would have had to provide, right? So you're helping the government out. And it's the same thing with an investor. So because you're helping the government out, they're providing ways for you to get benefits. So it's basically, I did good, here's a pat on the back. So this bill is really focused more on them. But for the tips and for the overtime and social security, that's for okay, so for the social security for seniors who are receiving social security, that'll be a boon for them. For the tips, so people who are working like waitresses, people who work for a lot of tips, that'll be a boon for them as well, because now there's a certain amount that they have to get to before that they can get taxed on their tips, right? And the overtime. But one thing though, people need to understand that there are also limits to that, right? I think it's like at $150,000 it caps. So if you're receiving $150,000, there are going to be taxes. But if you're below $150,000, there's no taxes.
Okay, that's really good to know. I like understanding that there's some limits on that. So,
Mhm.
walk us through like a specific case, maybe like a business owner who could save like a million or, or more using these kind of strategies. Give us like a case scenario.
Okay, so case scenario, and I'm gonna use my client because this is going to actually be what is going to be done for him this year. So my client purchased a farm. It is $2.5 million. There are 7 buildings on the farm. He's a hemp farmer. And so he's going to be drying, curing, extracting, because he's producing like he's refining hemp as well. So all these buildings are going to be used in production. And that's where the qualified production property part comes in, right? So now, because the buildings are being used in production, the value of those buildings are $1 million. Let's just say 2.5 million. I think 1.5 because he had them appraised. $1.5 million. So at $1.5 million, he can now deduct that full $1.5 million and get a tax break on that. So now if I pull up my calculator and I go 1,500,000 times 0.37, because that's a tax bracket that he's in, right? He gets a $555,000 reduction on his
Ooh.
tax bill. And that's using QPP only. Now he has businesses, he manages his businesses, and he has real estate. His wife manages the real estate. They qualify for REP, right? So he sold a business this year and purchased 2 properties this year. So both properties are placed in service. They qualify for REP because they're being self-managed, and he's going to cost segregate those. And on those cost segregation studies, he can now take 100% of the value of the cost segregation study.
Wow.
So that is a cool, between the QPP and the cost seg, that's a cool $1 million in taxes right there. So it is
Wow.
not just theory, it is being applied. And it can be applied not just at this level, because some people are like, well, I'm not at that level. How does it impact me? But if you're a small business owner and you buy equipment, you need equipment. So if you say, for example, I have another client who is in trucking. He's going to buy 2 new trucks, and that was his intention, to buy 2 new trucks for the year, right? But now, when he purchases those 2 new trucks, he can choose to expense them this year. And he is going to do that because he sold a business as well. And he has a tax bill that's waiting from the sale of that business. But if he buys those 2 trucks and he gets to depreciate 100% of those of the sale of the purchase of those trucks, then he gets to use that to wipe out the tax bill that's waiting on the sale of that business.
Yeah, see, this is so good. It really is a chest, a treasure map, right? So this sounds pretty complex. What are some key steps someone needs to take? I would say the first key step they need is they need to talk to you, right? They absolutely need to have a conversation with you. You're talking about someone saving $300,000 in taxes, $500,000 in taxes. And I know you've shared stories with me where you've helped people to eliminate and mitigate even more in taxes. So they definitely need to talk to you. But what are some key steps that they could take, that they need to take?
I would say the first thing would be an analysis. Again, just because you can doesn't mean you should. So an
Right.
analysis. You need to analyze if this is actually the best thing for you. So first you need to analyze, if I'm interested in doing getting equipment so I can take advantage of either Section 179 or bonus. But how does that impact my business? How will that impact my cash flow? Am I able to make those payments that are going to be required consistently without creating a bottleneck in cash flow for my company to prevent me from growing? You need to analyze that first. Then you need to understand whether the equipment that you're going to purchase actually qualifies for the benefits, right? Because qualification matters, right? So you need to know that. And I would say the most important thing on that list is get with someone. I may not be your person, and that's okay. I'm not everyone's person, but get with someone who speaks the language, who understands it, who doesn't just at the end of the month give you your P&L and say, hey, this is what you did for the month. What is the point of that? Because at the end of the month, it's already, I need to have strategy in place, not just these are your numbers, like a post-mortem, right? So get with someone who understands the rules, so that you know that you're in the best hands. That person knows the rules, knows how to apply them, knows how to strategize, and will not allow you to just go do something just because you think I can benefit from it now, but it is not the best thing for you in the long run.
Yeah, that's so good. Just because it sounds all sexy doesn't mean that you should do it. Just because you
Mhm.
can doesn't mean that you should. I
Mhm.
love that. I
True.
think that's a great key takeaway. And, for me, I say money likes speed. Wealth takes time, but money likes speed. You need to take quick action. But let me ask you, Chris, what are the timelines on this? Can we kind of take our time with it and, kind of mull around with it? Or what are the timelines?
Um, Not really take your time. We're in July, right? And there's retro back to January, but retro doesn't count for the people who haven't applied it yet. It is for what happened. It is for what happened before, right? So we're coming up on the to the end of the year, and before you know it, the end of the year will be here. So
Yeah.
if you are going to have a plan in place, if you intend to use strategy rather than that wait and I'm gonna do the mad tax dance when we get to April, then the time to take action is now. Because the mad tax dance doesn't benefit anyone. It
Right.
doesn't benefit you, and it sure doesn't benefit me because I do not respond to mad tax dances. So there's I say the mad tax dance because there are people who, when it gets to the ending of March, beginning of April, they're forever in your inbox, sending you all these messages, right? Can I do this? Can I do that? Is it too late for this or is it too late for that? But guess what? You had the whole year and you
Right.
didn't plan. April is too late. So the what you need to do, you need to start now.
Yeah. The mad tax dance. Don't do that one. Okay. We
Yeah.
don't want to be doing that. We want to do the happy dance. We don't want to do the mad tax dance. That's not good. So let's talk about, you've mentioned to me many times about recapture. So what does this mean and how do people avoid that?
So you follow the rules. So recaptures, basically what IRS is saying is the benefit that you're getting in case of bonus depreciation, you get that you don't recapture until the asset is sold. So depending on when you sell the asset, will determine how much recapture you have. In case of Section 179, it's saying that there are specific rules. You have to keep those assets within 5 to 7 years, and you have to use the asset 50% for business use. And if you break those rules, then you're gonna have to pay back the benefits that you got. It is really that simple.
Yeah, that's so good. So let's talk about, and obviously this is not a DIY. This is not something you do yourself. And a lot of tax professionals are, in my humble opinion, they are more historians. They're really not tax strategists. They don't really look holistically, proactively on your situation. So, what should someone do? What should they look for in a tax professional?
The first thing is when you're speaking with a tax professional, you need to be able to discern if that is the person for you, and you do that by active listening. Like, what are they saying to you, right? um is it someone who's telling you? So I had a client who tax bill is like $320,000, and he's CPA, and I have respect for CPAs, but sometimes there are some CPAs that, yeah, let's leave it right there. But at 320 with a $320,000 tax bill and a CPA that he paid $70,000 for the year, but he has a bill of $320,000, and you're telling him that just write the check because it just means that he's successful. What, are you kidding me? Are you kidding me? So you need to know when you speak with people, what are they saying to you? Are they more concerned about, well, the IRS this or the IRS that, or an IRS audit? And I'm not saying don't be concerned about IRS audits. You should be concerned about IRS audits. But if the things that you are doing are legal, then it doesn't matter if you get audited, right? It doesn't, because you know that you can go through an audit and get an unchanged decision. Are they strategizing? Are they just telling you basic things that you can find on the internet yourself? Or are they really bringing strategies to you that you don't hear common people speaking about commonly? And when they're speaking with you, are they educating you? Because I never tell anyone to do anything without educating them. If I create a tax plan for a client, when I present the plan to the client, I go through the strategy step by step. Each
Right.
strategy, this is what it is. This is why we're using it. This is the foundation of it. This is how it benefits you. I educate them. So, are they interested in educating you? Are they interested in your plans? Well, when I have a conversation with a client, I want to know, what are your plans for the next 5, 10, 15, 20 years? Because that
Right.
allows me to really personalize a plan for you. I want to know what you want financially, relationally. What kind of life do you want, and how do you build that life? It is not just the finance piece, it is all of it, and how the finance piece ties into that. Are they talking to you about that? If they have no idea what your plan is, let's just say even on the financial level alone, if they have no idea what that is, how are they going to create strategies for you? So you have to
Yeah.
look out for that. What are the questions that they're asking you? Are they interested in the future you? Because if they're not interested in the future you, they can't plan for the present you. Because planning is not for the present, it's for the future.
That's a mic drop all day long and twice on Sunday. You know, and how I really leaned into this is I had a client who had inherited a huge estate. It was about 40 properties in the Bay Area. The dad had bought himself a birthday gift of a new piece of real estate every year for over 30 years. So imagine that. We're talking about Silicon Valley. Okay, Silicon Valley, all that area. And my client ended up having to, I kept asking him, you know, what is the strategy exit plan? This was back years ago before I was really a strategist, but I knew enough to be dangerous. And finally, he said, you know what? The final disposition on that estate was he had to write a check for over $5 million.
Oh,
They
dang.
had to liquidate, sell estate, sell the real estate, sell the beach house, sell some things, and I asked him, well, what did your tax person tell you? He said, you know what? He just said, Bob, just write the check. And so I would say to any of you who are watching this now or on the replay, if your CPA, your accountant, your tax professional says, don't worry, just write the check, I say you need to talk to Miss Chris or you need to talk to somebody. Listen, don't pass go. Do not collect $200. We don't have to write the check. It's not illegal. It's a treasure chest. It's written there for us. It's a roadmap. But most of us are playing what? Money checkers. Stop playing money checkers. We got to know the rules of the game. We got to play money chess. So somebody who's watching this, and they want to take action, what are some next steps for them?
Come find me.
I concur that. I absolutely do.
Yeah, that's it. The next step is come find me.
Okay, perfect. Well, you're easy to find because you're right here. I see you all over
Right, and
social
right here,
media.
right? And
You're
right
right
here, you can
here.
find me on LinkedIn, you can find me on Facebook, Instagram, TikTok. I'm the same person. You can find me
Oh,
everywhere. Come find
that's
me.
right. I love it. And if you don't know how to find her, find me. I'll find her for you. I promise you, I know where she is. So, if you could give some final advice to our audience, one key of advice that you would give them about these tax opportunities that really everybody should kind of put in their pocket today.
I would say that these, regardless of what public opinion is about this bill, there are strategies in this bill that gives us the opportunity to actually create wealth. So take advantage of them. Do not sleep on this. Do not, if I had known. So like a couple years from now, you're going, if I had known. The opportunity is in front of you. Take advantage of it.
Yeah, that's so good. It's here for us, right?
Mhm.
When we know better, we do better. I say, whatever happened, sometimes you can go back and you can change some of the taxings that were done, but oftentimes you can't. Okay. That's just, it is what it is. But now you know better. You watch this now live or on the replay, and you have some information. You know, if we don't have wealth, if we're not born to a wealthy family, that's not our fault. But we have to come from a wealthy family. We have to develop a wealthy family ourselves. I say that it's
Mhm.
our turn to rise up and thrive, to build our family dynasty. We got to build that legacy so we can create generational wealth, and we truly can. I don't care where you're starting from. Whether you think you have too much month at the end of your money, whether you think you've got too much debt, whether you have absolutely no money that you think of, I'm telling you, you could literally go from zero to hero and change your family's last name forever. But we got to start playing money chess. We got to understand the rules of the game. Now we have to start to implement and take action. Don't stop and just think about this. There's nothing for you to think about because she doesn't even know if this will work for you. Heck, we don't even know if this will qualify for you. But it's at least worth a conversation. If your tax person is just saying, just write the check, have a conversation with Miss Chris. I promise you, she's nice. She's warm and fuzzy. She won't make it boring. She's going to really break it down for you in our layman's terms so that we can capture this and really understand if it's something that we should do or not do. And one thing I will tell you, she said something that was so profound. Just because you can doesn't mean you should. A lot of times people think, well, I can write this off. Yeah, but should you? Chris is going to show you if you should and how that would look long term. So I think that's so critical, so critical. So we're kind of winding down here. I know people are going to want to reach out to you. You've made a lot of old friends and new friends. Do you have any key takeaways or just some last tips that you want to share with us?
So I'd say that a lot of people don't ask questions. They don't call. They don't book the call because they think, well, this is not for me. And so do not do that. You won't know until you try, book the call, find out. Because my mom always said this thing to us. She said the only thing that beats failure is trial. Because if you try, then you will find out. And if you don't, you definitely are going to fail because you did not try. So book the call, have the conversation. And again, it may not be with me, it may be with someone else, but book a call, see if this works for you. And the next thing is we put limitations on ourselves, right? Everyone is thinking, well, these are for millionaires, these are for the elite, this is for the elite and all of that. Well, maybe where you are, it might not work for you now, but where you're going, it might. So what's the plan for getting you there? And if this particular strategies won't work for you, there are others that will. So still book that call.
I love it. I love it. I love it. Well, that's going to kind of do it for us. Again, my name is Leah Garcia, financial strategist and insurance professional. And it's really my crusade to serve entrepreneurs, business owners with 20 to 50 to even 100 employees. And I help them to properly protect, distribute, and transfer their wealth so they can build that legacy and create generational wealth for their family. Folks, we've already had generational poverty. It is time for us to flip the script and have generational legacy, generational wealth, generational prosperity. I believe it is our fiduciary responsibility to leave our family better than we were before. We have to leave every generation better than they were. Otherwise, we're just doing the same old thing that's been done. We've already had generational poverty. Now it's time for us to have generational prosperity. Reach out to me. I'd love for you to download my free one-page financial plan, which is the Wall of Wealth. And it is absolutely another treasure map. It is a game changer. It will help you to identify the blind spots in your financial plan. Super quick, super easy. If you talk to wealth management financial advisors, they want us to think that money is complicated, but it's really as simple as A, B, C. So that's going to do it for us. Thank you so much, everybody. Appreciate you. Thank you for all the comments. Thank you, Miss Chris. This was fun as always. Believe it or not, she makes taxes fun, you guys. So thank you, everybody.
Bye.
Bye.